Welcome to the deep dive. Today, we're peeling back the layers on something that's quietly, but yeah, profoundly shifting the ground beneath global finance.
Mhm.
It's not just the volatile cryptocurrencies making headlines, but they're much more stable cousins,
That's right.
stable coins.
That's right.
And what's truly fascinating is their surprising and, frankly, far-reaching impact on economies worldwide.
Indeed. These digital assets, they're really no longer just a niche curiosity. They're posing strategic challenges, but also presenting significant opportunities, especially for a major economic player like Europe.
Absolutely. So for our deep dive today, we're going into an insightful piece from the European Central Bank blog. It was published July 28th, 2025 by Jürgen Schaff.
Right. The title was From Hype to Hazard,
Hmm.
What Stablecoins Mean for Europe.
Exactly. So our mission is to unpack what stablecoins actually are, how they've kind of exploded onto the scene, the very real hazards they present, and critically, what Europe is considering as a, well, strategic response.
Yeah.
Get ready for some genuine insights because this conversation affects much more than just the crypto market. It really touches on global economic power. All right, let's begin by grounding ourselves. Most people know cryptocurrencies like Bitcoin. They can swing wildly in value.
Oh, definitely.
So what exactly are stablecoins and how do they manage to stay, well, stable when they're still crypto tokens issued on distributed ledgers or on-chain?
That's a crucial distinction. Unlike those non-backed crypto assets that famously lack intrinsic value and are, well, highly volatile,
Right.
stablecoins are specifically designed to maintain a stable value. They achieve this by pegging themselves, typically, to a traditional asset like the US dollar.
Okay.
The idea is that you can convert them on demand at par to the underlying asset. Think of them as a vital bridge between the often turbulent world of digital assets and the more familiar, stable, traditional monetary systems.
So they offer that much-needed predictability. You mentioned convertibility at par. That's their core appeal, right? Being liquid and globally transferable while being perceived as stable.
Exactly. That's the goal.
Who are the primary architects behind these digital bridges?
Well, they're mostly issued by private companies,
Yeah.
names you've likely heard, like Tether, USDT and Circle USDC. They really dominate the landscape.
Okay.
And the mechanism is pretty straightforward. When customers provide traditional currency, say US dollars, the issuers take that currency and invest it in highly safe liquid assets, often short-term US treasuries.
Ah, okay. So that's the backing.
Precisely. This backing ensures that the stablecoins can, in theory, always be redeemed, maintaining their peg.
Right. And originally, their main draw was that lightning-fast ability to move value between different crypto assets or to send money across borders for things like remittances, bypassing the traditional banking system altogether.
Yeah, that was definitely a key early use case, a kind of digital express lane, like you said.
Now, here's a reality check that might surprise you. While stablecoins are global in reach, the source points out a striking dominance by one particular currency.
Yes, it's quite stark, actually. U.S. dollar-based stablecoins account for about, get this, 99% of the entire stablecoin market capitalization.
99%. Wow.
Yeah. In contrast, euro-denominated stablecoins are, well, they're barely a blip on the radar, market cap less than 350 million.
Hmm.
While there are whispers, some European banks preparing to enter this space, the scale currently remains incredibly limited compared to their dollar counterparts.
That's an almost complete dollar monopoly then. And while the overall stablecoin market is still, dwarfed by traditional financial assets,
Sure, in the grand scheme of
we're
things.
clearly no longer a niche. We're seeing them become more and more entangled with traditional financial institutions through things like custody arrangements, derivative exposures.
Mhm.
What's the fundamental concern for financial stability when this digital plumbing starts connecting to the traditional system?
Well, this growing entanglement is precisely where the systemic risks start to emerge. I mean, a disorderly collapse of a major stablecoin, or even just a widespread loss of confidence in their peg.
Yeah, like a run.
Exactly.
Yeah.
That could easily reverberate across the wider financial system. It creates a significant risk of contagion. And central banks, like the European Central Bank, are acutely aware of this.
I bet.
The Bank for International Settlements, the BIS, they highlighted this in their annual economic report for 2025, specifically warning about stablecoins undermining monetary sovereignty.
Right, a country's control over its own money.
Precisely. And highlighting transparency issues. They even noted the, and I quote, fragility of their peg, observing instances where stablecoins deviated substantially from their intended par value.
Not so stable then sometimes.
Well, that's the risk.
So we've got this emerging dollar-dominated digital currency growing rapidly and intertwining with traditional finance, all while different regions are trying to regulate it. What does this regulatory divergence mean for Europe specifically?
This brings us to a really critical point. The United States is moving forward with its own stablecoin regime. It's called the Genius Act, signed into law July 18, 2025.
The Genius Act, okay.
Now, while it shares the spirit of the EU's markets in crypto assets, or MiCA, regulation.
Which Europe has been working on for a while.
Right. The U.S. Act is notably more lenient in certain areas, particularly around, say, requirements for reserves or how strict the oversight is.
More lenient. Interesting.
And this regulatory environment is actually fueling projections that the global stablecoin supply will skyrocket from about USD 230 billion this year to a staggering USD 2 trillion by the end of 2028.
$2 trillion by 2028. That's an absolutely massive jump.
It really is.
So how does that incredible growth, particularly under a U.S.-centric regulatory framework, translate into concrete implications for the euro area, for people and businesses in Europe?
Well, okay, on the payments front, stablecoin adoption is gaining serious traction. Think cross-border remittances, e-commerce, major U.S. card schemes, Visa, MasterCard, they're already integrating stablecoins. And retail giants like Walmart and Amazon are actively exploring their use.
Wow.
Now, if this becomes widespread, it could shift high volumes of transactions outside the traditional banking system, which typically uses euro-denominated payments within Europe.
Right, bypassing the euro in some ways. And it goes beyond just everyday payments, doesn't it? They're increasingly being used for settlement in the financial markets themselves.
Exactly. They're commonly used for settling trades in decentralized finance, or DeFi, on crypto exchanges and in these emerging tokenized asset markets.
Okay.
Their appeal here is clear: speed, global accessibility, interoperability. But as they integrate with traditional systems, this comes with new risks. Around regulation, who you're dealing with, that's counterparty exposure, and just ensuring they integrate seamlessly and securely.
The source also flags a detail that might seem minor, but has massive potential implications. The idea of interest being offered on stablecoin holdings. How does that seemingly simple feature create such a significant vulnerability, especially for the traditional banking system in Europe?
That's a crucial insight, actually. While stablecoins don't inherently offer interest.
Like a bank account does?
Right. But some platforms have innovated to provide a return on stablecoin holdings, similar to a savings account. On the surface, it sounds appealing.
Sure, who wouldn't want interest?
But if interest-bearing stablecoins became common and widely adopted by businesses, they could effectively divert significant deposits away from traditional banks.
Ah, I see. So money leaves the banks.
Exactly. And for Europe, this is particularly concerning because banks play such a central role in the economy, and deposits are their primary source of refinancing. If those deposits flow elsewhere, it could jeopardize financial intermediation, that essential process where banks connect savers with borrowers. It could potentially hamper credit availability for businesses and individuals, which in turn impacts the entire real economy.
That's a serious knock-on effect. And for the European Central Bank, the ECB specifically, what does widespread U.S. dollar stablecoin use mean for its ability to, manage the economy?
Well, if U.S. dollar stablecoins become widely used in the euro area for payments, savings, settlement, the ECB's control over monetary conditions could be significantly weakened.
Its main job, basically.
Pretty much. Its ability to manage inflation or influence economic growth through interest rates and money supply gets diluted. This gradual encroachment, it kind of echoes patterns seen in dollarized economies where foreign currency gains widespread acceptance. Users might seek perceived safety or perhaps higher yields unavailable in euro-denominated instruments. And such a shift in economic dynamics is incredibly difficult to reverse once it takes hold.
So this isn't just about the convenience of digital payments. It has profound geopolitical and economic weight.
Absolutely. The sustained dominance of the U.S. dollar through stablecoins would provide the United States with significant strategic and economic advantages.
Like what?
Well, it allows them to finance their debt more cheaply, because there's increased demand for U.S. treasuries to back these stablecoins.
Ah, okay. More buyers for U.S. debt.
Right. And it extends their global influence. For Europe, this would mean facing potentially higher financing costs relative to the U.S., a reduction in its monetary policy autonomy, and, well, an unwelcome geopolitical dependency.
And the U.S. knows this.
Oh, yes. The U.S. administration has been quite explicit that their support for stablecoins isn't solely about innovation. It's a deliberate strategy to expand the U.S. dollar's global dominance.
Right. Okay. Given these significant challenges and the looming shadow of U.S. dollar dominance, what are the options for Europe? The source says there's certainly no room for complacency. What strategic path can Europe forge?
You're right, it's definitely a moment for proactive strategy, not just reaction. Several key policy levers are on the table. First, they're supporting the development of properly regulated euro-denominated stablecoins.
Okay, fight fire with fire, sort of.
In a regulated way, yes. These would be designed to very high standards with effective risk mitigation. And, importantly, they could serve legitimate market needs while simultaneously reinforcing the international role of the euro itself.
And Europe has been diligently working on its own central bank digital currency, the digital euro. How does that project intersect with this stablecoin discussion?
It's seen as complementary. The Eurosystem's digital euro project and private sector innovations, like regulated stablecoins, could form a multi-pronged approach.
So not one or the other.
Exactly. The digital euro promises to be a robust line of defense for European monetary sovereignty, particularly in everyday payments, where you interact directly with the currency. It ensures the ECB remains central to the digital economy.
What about the underlying technological infrastructure? We hear a lot about distributed ledger technology, or DLT, blockchain tech.
Right. Increased use of DLT in wholesale financial markets is seen as critical for future financial infrastructure.
Wholesale meaning big bank-to-bank stuff.
Yes, large value payments, security settlement. DLT offers potential improvement for both domestic transactions, like settling tokenized financial assets directly in central bank money, and especially for cross-border payments, which, let's face it, often suffer from considerable costs and delays.
Definitely.
The Eurosystem's Pontes and Appia initiatives are key explorations here. These are specific projects looking into how DLT can make wholesale finance more efficient within the Eurozone, basically laying the groundwork for a more modern, robust financial future.
Okay, exploring the tech. And finally, when we zoom out to the global stage, what's truly crucial for avoiding fragmentation and ensuring stability?
Stronger global coordination on stablecoin regulation is absolutely pivotal. Without consistent, internationally agreed-upon rules, fragmentation will just persist.
Which leads to problems.
Big problems. It risks instability. It encourages regulatory arbitrage, where companies just hop to the place with the loosest rules.
The path of least resistance.
Exactly. And ultimately, it reinforces global U.S. dollar dominance, potentially undermining the stability of the entire financial ecosystem. So global cooperation is key.
This deep dive makes it crystal clear that stablecoins are, well, they're no longer a niche curiosity. They are quickly becoming integral to the future of digital finance.
Yeah, they really are.
Their design, their governance, even the currency they're denominated in. It might just be the quiet shaper of the entire future monetary landscape.
The associated risks are obvious. I think we've covered that, ranging from operational resilience, payment system safety, to broader financial stability, and, as we discussed, monetary sovereignty. However, this period of uncertainty, it also presents a unique opportunity for Europe. Its stable institutional framework, its rules-based approach, that provides a solid foundation for trust.
Indeed. If the Eurosystem and the European Union can build on this with robust regulation, strategic infrastructure investment, and thoughtful digital currency innovation, well, the euro could very well emerge from this period of profound change as a significantly stronger currency.
I agree. In a world of, shifting sands, the euro truly has the potential to be a bedrock on which others can build, a stable anchor in a rapidly evolving financial world.
So as you consider this rapid evolution of digital currencies and this emerging global competition for digital dominance, here's a thought. What implications might these shifts have for your own financial landscape, far beyond just currency exchange? Something to think about.